Hi, welcome to the third and concluding module on our short duration course, the one that we call Managing Money and Orientation. In this third module, we'll take a look at an instrument, at a process that many of you would possibly be conversant with, banking. We'll have three learning goals. One, we'll get to know what is banking as a process. Two, we will try and understand the new world of banking, which is digital banking. And three, we'll also figure out as to what are the few checkpoints that you must keep in mind before you choose to invest in the product of a particular bank. So let's get started with banking basics. Let me ask you a question. How many of you have actually stepped into a bricks and mortars bank? Have actually stepped into a physical bank in order to draw cash or to carry out any of the other many transactions that people can actually do? I ask you that question because I have asked a few people of your age, and many of them have gone on record to say that they have never stepped into a physical bank, never got the inside of a bricks and mortars bank to draw cash. Plus, they have never gone there to avail a banking service. This is obviously not surprising because in the space of the last 20 years, banking has undergone a metamorphosis. Today, all of you know that you can draw cash from an automated teller machine or an ATM, which incidentally even sits in street corners. Many of you should also perhaps know that bankers drop in at your home, at least the new generation bankers drop in at your home to deliver on the many services that the banking industry provides. Opening a bank account is possibly one of the most exciting things for a teenager. Investing in a banking product, I guess, should be equally exciting. But before we do that, before we take a look at that, let's try to understand what does a bank do? What happens in a bank? What kind of role do you play? You and me deposit money into a bank. It goes into the bank's saving account. It goes into the bank's current account. It goes into the bank's recurring deposit account. It goes into the bank's term deposit accounts. In other words, banks collect a whole lot of money from customers like you and me. What do they do with that money? They lend that money. They give that money out to small and medium entrepreneurs. They give that money out to large enterprises. And to that extent, we can say that you and I, as customers of bank, as lenders into the bank, are in part doing a small exercise in nation building. The bank raises money from us at a certain percentage, say X, lends to other people at a certain percentage which is higher than X, say Y, and the difference between Y and X turns out to be its gross margin. Let's say Z is its gross margin. From this margin, all the expenses that it incurs are removed. Let's call it P, and it has a net profit which would then be Z minus P. So far, so good. We have very, very crudely put across how a bank earns money, how a bank spends money, and what is its profit. There are a few pieces of good news. First and foremost, banks don't work in isolation. Banks world over are regulated by a central bank. And in India, the central bank is the Reserve Bank of India. To put it very crudely, the Reserve Bank of India is the big boss. The Reserve Bank of India is the one which regulates every other bank. So what are the advantages of putting your money into the bank? First up, banks are regulated, as I just now said, and therefore the risk of losing money is less. I'm not saying that banks have not failed. There are stellar examples in recent times. Lakshmi Vilas Bank came very close to breaking down. Punjab National Bank went through a crisis. There are many more banks that have faced such a situation, but in none of them did the deposit holder, the ordinary man like you and I, lose out. A second advantage of banking is that bank pays you interest on the deposits that you make. 3, you can nominate a person as your nominee in your bank account, which means that tomorrow, God forbid, something happens to you, the money can without great legal difficulty be transferred to the nominee. You can hold different types of accounts in the bank. You can hold an account in your name. You can hold an account jointly in your name and your dad's name, or in your name and your sister's name. So you can have an individual account, you can have a joint account as well. One of the most important advantages of banking, placing money in a bank, is that these monies are protected. These monies are insured to the extent of rupees 5 lakhs. Cutting across various branches of a bank, cutting across different forms of money, up to rupees 5 lakhs in a particular account is protected. So let us say that you have 5 lakh rupees in the deposit of a bank. Let's call it Bank X. And tomorrow Bank X collapses. Let's say Bank X is a scheduled commercial bank. Then the government guarantees that it will pay you rupees 5 lakhs. So the chances of losing money when you place money in a bank is minuscule, and that, you will agree, is a great advantage. Now that you know how a bank operates, now that you know that there is very little chance of losing money that's placed in a bank, let me try and explain to you how to open a bank account. Let me talk to you about the few documents that the bankers ask. And most importantly, let me tell you what is the purpose of asking those documents. A bank normally takes 4 key documents from a customer. This, of course, is in addition to the account opening form. It takes a snap, a photograph of you. It also picks up some form of proof of your identity and your address, and a copy of your PAN card. The identity proof as also the address proof are KYC documents. KYC stands for Know Your Customer. The reason for a KYC is simple. Because banks deal with money, they have to be ultra cautious about who opens the account. Is that person a genuine person, and that he is the same person as he claims to be? This is absolutely necessary in order to prevent a fraud. Let me give you an example. If a friend of yours commits a fraud, receives illegal gratification, and opens an account in your name and puts that money into your account, if you said you will get all the money that belong to him, you may be right, provided he leaves the money there. He might withdraw the money and run away. And then when the cops get suspicious, cops get a hang of the transaction and see that the money was routed through your account, they will think you were involved. That's why banks have to be so careful about who opens an account. The permanent account number, or the PAN, is the number through which grown-ups pay their taxes. The government wants to keep a track of the money that is routed through your account and also see if the income tax on your investments are paid. That's why the bank asks for a PAN card. The passport can also act as an identity proof and address proof, since it has both your address and your photo on it. In short, your Aadhaar card, your driving license, your voter identity card, and your passport are called for. While the passport acts as a proof of identity and proof of address, the PAN card can be used as a proof of identity only because the PAN card does not capture an individual's address. Now that you know what documents are required to open a bank account, and more importantly, now that you know why those documents are required, let's quickly run through a few products that the bank has. It offers you a savings bank account. You can open a savings bank account with the bank. Into this account, you can deposit money. From out of this account, you can withdraw money. And you'll earn a small rate of return for the money that lies with the bankers during the course of the month. This is not exactly an investment product. This is the equivalent of keeping money in your home locker. This is the equivalent of keeping money in your wallet, with one difference, that the money here is safe and the money earns a small rate of return. If you think that you don't need that money, if you think that that money should earn you higher return because the interest on the savings bank account is small, you can place the money in a term deposit with the bank, or we'll call it, for simplicity, we'll call it a fixed deposit with the bank. The great advantage of deposits with a bank is that you can take a deposit for as small a period as 15 days to as long a period as 10 years. And the interest rates for different tenors are different. Would the smaller period have lower interest rate, or would the higher period have lower interest rate? Has a lot to do with the liquidity of the bank. But the rough thumb of rule is that longer the period, the interest rate for you will be more. Now let us assume that you don't have too much of money to put in a deposit. You have small amounts only. Let's, for argument's sake, say that if you had 12,000 rupees, you would have opened a fixed deposit. But you think you don't have 12,000 rupees. But you know you'll have 1,000 rupees every month saved with you. You can now open a recurring deposit. This is something very similar to what the mutual fund industry calls the systematic investment plan, or the SIP. What happens in a recurring deposit is that if you open up a recurring deposit account for 1 year, you will make a deposit every month. So your first deposit is something like an investment for 12 months. Your second deposit is something like a term deposit of 11 months. Your third deposit is something like an investment for 10 months. So every month you will invest rupees 1,000, and at the end of the 12th month, all this money along with the interest thereon will be paid to you. So we looked at 3 forms of investments. One was savings, which gives you a very low rate of return. Second was a term deposit, which is safe and gives you a higher rate of return. And third, if you did not have the money or if you wanted to build a savings habit, is a recurring deposit, which also gives you reasonable good rate of return. But if you ask me, the greater advantage of a recurring deposit is that it creates the healthy habit of savings in you. One quick point that I would like to make before we move into the second learning goal, and it's possibly a point that I had already made, is about nomination. Whenever you open a deposit or whenever you open a bank account, name a nominee. A nominee is the person to whom the money goes. If for some unfortunate reason the account holder dies, let's say Sam is an account holder. When Sam opens his account or on any date thereafter, Sam must appoint a nominee so that if unfortunately Sam passes away, the money will go to the nominee without great legal hassles. I just wanted to quickly add a supplementary to this. The fact that a nominee receives money does not necessarily make him the owner of the money. If there is a will that Sam has written, while the money goes to the nominee as at level 1, that money has to be passed on to the beneficiary of the will. If Sam dies intestate, that means Sam dies without writing a will, then the money goes to the nominee. Let me quickly summarize what we have done so far. I have tried to tell you that banking is an important product. I've also tried to tell you as to why bankers call for KYC documents. And I just now closed out by telling you that while there are 3 interesting products that banks offer you, and you might like to choose them because they are on the lower end of risk, you must appoint a nominee lest in case something adverse happens to you. Thank you.